all through the last 2 or 3 weeks, we've been noting that it's very interesting moves that are happening in the bond markets across the world. The German yields, the French yields yesterday, the US yields and the way they have behaved as well. What's happening on this front? What is your analysis there? And whether it can have any kind of an impact on fund flows across the world?
Yeah, so I think there are two basic sort of uncertainties prevailing, at least in the DM world, and that obviously has impact for us. So one is the massive pothole in first quarter growth in US. Why did that happen? And is this simply a repeat of what happened last year, which was bad weather and variety of other, port closures, et cetera, creating it? Or, as San Francisco Fed came out with a report a few days back saying that, well, we are basically mismeasuring seasonality, and really the pothole is not -1. So there's a lot of confusion as to what happened in first quarter. And there's a lot of confusion, therefore, as to what will happen in the second quarter. And all of this, whether the second quarter will be a recovery strong enough, whether the labor market gains will hold up, such that ultimately you are answering the question whether the Fed moves in September or doesn't move in September. I think much of the volatility that you're seeing in the bond market is essentially a reflection of the uncertainty surrounding the global funding costs, which is what is the price of treasuries. And in the absence of getting a very firm view on where the Fed moves in September, where the Fed pushes it to the end of the year or doesn't even move in 2015, I think that uncertainty will continue, and that will continue to get reflected in these very volatile episodic moves in the bond market.
You actually hit the nail on the head. I don't know how, a lot of people keep on changing their commentary almost every single quarter, but the baseline is that it'll probably happen in September or December or maybe post that. But what about Europe as well, Jahangir? And how we gonna, again, I'm just talking from the perspective of an impact that it can have on the emerging market pack. I read a lot of commentary of late about how European earnings and therefore European economies may have probably bottomed out and could actually improve meaningfully over the next 6 months. Are you, in whatever you're reading, seeing signs of that?
No, that's basically has been the consensus trade, right? So the consensus trade is that it is time to move into European equities, because that's one place where we know things are going to pick up, largely because you have ECB, which will continue to ease against a Fed that will tighten, i.e. therefore all of this is going to have an impact is on a weakening Europe. Now, we did see a weakening Europe in the first quarter of this year. That sort of got pushed out of the way because of episodic strength back in the with the dollar weakening because of the first quarter GDP slowdown. But my sense is that if you have a situation where ECB is going to continue to loosen monetary policy or continue to ease monetary policy, where the Fed tightens, whether in September or December, necessarily it has to be a story of dollar strength. And if you have a story of dollar strength, then it is almost a play on that, where you are looking at European equities, particularly export-oriented European equities and financial sector, which is where I think much of the equity improvement or price improvement is taking place in Europe. But the problem is that a further weakening of the euro combined with a further weakening of the yen essentially means that all of our EM Asian currencies is going to strengthen after having strengthened significantly against the euro and the yen, and the dollar weakness isn't enough, or the weakness against the dollar isn't enough to offset that, such that EM Asia is one place where we have seen a significant tightening, not only of financial conditions, but also of real and nominal effective trade-weighted exchange rates, and that is having a pretty large dampening effect on EM Asia exports, as you could see from the Taiwanese data that came out, or from the China data that came out recently.
Since you talked about China, Jahangir, I'm going to pick it up exactly from there, because that seems to be giving sleepless nights to investors back here in India. The PMI data, recently has not been all that encouraging, and, talks of stimulus again are back on the street as well. What happens to the Chinese economy, and does it seem like there's a bit of a disconnect in terms of what the stock markets in China are doing than what the reality on ground is?
Yes, I mean, that's a fair assessment, that if you look at what the stock market has been doing, it is largely being driven by retailers. There is not very many institutional investors in China pushing up the Chinese stock market. It's much more a retail play. What is worrisome is that many of the institutional investors are now following retailers, which is never really a very good sign. But much of that improvement or the pickup in Chinese stock market has been driven by the monetary easing or the policy easing, along with the fact that it had really been beaten down very badly over the last 2-3 years. Add to that the fact that deposit rates haven't been going up very much. At the same time, you've had real estate prices have been declining and continues to decline. So, the liquidity that has been pumped into the economy over the last 1.5 months is sort of finding its way into the retail stock market. The economy, on the other hand, so far still hasn't shown any firm signs of recovering. Now, the problem with that is that we tend to forget the fact that Chinese policymakers, at least over the last 1.5-2 years, through policy design, is trying to push the economy down on a declining path. They really want to get the economy stabilizing somewhere below 6% growth or below 7% growth rate in the next 1.5 or 2 years. Whatever policy support that you are seeing is essentially with the aim of fearing that the decline might be too sharp. And therefore, the policy support is only meant to deliver sufficient impetus so that the growth does not fall too sharply below 7%. This isn't a policy regime where the policymakers are trying to push China back to the 9-10% growth rate. So I think there is a sense of sort of expectations probably in the market are probably on rate cuts and policy easing are probably running a bit too high. In terms of where Chinese policymakers want the economy to be and where we want the Chinese economy to be. I mean, we really want the Chinese economy to be back to the 9-10% so that commodity prices are back up and everybody's having a good time. But that's not where the Chinese policymakers want China to be.
Jahangir, some would argue that rate cut is a sufficient but not a necessary condition for the revival of Indian economy. We've got 2 rate cuts. Little bit of transmission has happened, a lot of feel-good factor is back, yet there is no real economic recovery. The private sector balance sheets are bust, government is ready to commit, but the real activity has not rolled out.
I will agree with that. I mean, we've been making the same argument for a very long time. I think there are binding constraints in India that is keeping corporate investment from actually taking off in a very sharp way. And those binding constraints still haven't been fully addressed. You mentioned one of the key binding constraints at this point in time, which is the over-leverage of infrastructure companies and the fact that on the back of that, you're not seeing enough credit growth. NPAs in public sector banks have been rising and they are in dire needs of recapitalization to get any kind of supply-side response to the credit growth problem. Having said that, I think we are probably at a point, if you look at the rate at which new projects are coming up, or if you look at the monthly rate of existing projects that have been stalled, the stalled project rate has actually slowed down sufficiently and is almost bottoming out over the last 2-3 months. If you look at new project announcements, again, they are starting to pick up. Nothing in that suggests that we are going to go back to a very sharp recovery anytime soon. But I wouldn't say that things on the ground finally are looking to stabilize and a recovery of sorts is forming. Now, that isn't very encouraging news. But I think that that continued decline in corporate investment, continued increase in stalled projects, I think those days probably are over at this point in time.